Welcome to The Explainer. Today we're tackling a question that sounds simple but has an incredibly complex answer. Who exactly is funding the United States?
Okay, let's just start with this number. $38 trillion. It's kind of hard to even wrap your head around, right? Well, that's the US national debt as of 2025. And get this, that number has literally doubled in just the last 10 years. So a number that big obviously raises a couple of massive questions. Who is lending America all this cash? And maybe more importantly, what happens if they decide to stop? This affects everything, by the way, from global politics to the interest rate on your car loan.
All right, so to begin to answer that, we've got to look at a really surprising trend. It turns out some of the biggest, most reliable buyers of U.S. debt are, well, they're changing their tune. Just take a look at this. Now, don't get me wrong, foreign investors still hold an insane amount of U.S. debt. We're talking over $8.5 trillion. But their overall slice of the pie, it shrunk a lot. A decade ago, they held almost half the market. Now, it's down to less than a third. And if you dig into who those foreign buyers are, this story gets even more interesting. So Japan is still the biggest holder, no surprise there. But look, the UK has actually leapfrogged China for the number 2 spot, and China's been steadily selling off its holdings for a while now. But maybe the biggest headline here is this last point. For the first time ever, it's private investors abroad, not foreign governments, who own the most US debt. That's a huge shift. Okay, so this change in who's buying brings us right to the heart of the matter, the U.S. Treasury auction. This is basically the engine room of government finance. It's how trillions and trillions of dollars in debt actually get sold every single year. And the U.S. uses this really unique system called a Dutch auction. Here's how it works, in a nutshell. First, the Treasury accepts all the non-competitive bids. These are from people who basically say, hey, I'll take the bonds at whatever the final interest rate is. Then it starts looking at the competitive bids, starting with the investors who offered the lowest interest rate, and it works its way up until the whole batch of debt is sold. And here's the clever part. Everyone, competitive or not, gets the exact same interest rate, which is the highest rate that was accepted to get the deal done. Now, the most important players in this whole drama are the primary dealers. Think of them as a special club of big banks that have a deal with the Federal Reserve. And part of that deal is they are required to show up and bid at every single auction. They are the ultimate backstop. They guarantee the government can always sell its debt. So imagine this. Hundreds of billions of dollars in bonds just got sold in a matter of minutes. How does anyone on the outside, investors, analysts, how do they know if it actually went well? How do you measure the strength of one of these auctions? Well, they look at 3 main things. First, the interest rate itself. Did the government have to pay more or less interest than the market was expecting? Second, you look at the buyers. How much of the debt was snapped up by long-term investors versus how much was left with those dealers who are probably just going to resell it? And finally, the big one, the bid-to-cover ratio. This is simple but crucial. For every $1 of debt that was for sale, how many dollars in bids came in? A ratio over 2 is what you want to see. That's a sign of a really healthy appetite. So with foreign buyers stepping back a bit, you can see how the pressure really starts to build on those primary dealers, right? They're the shock absorbers. And the big question becomes, can they actually handle that extra load? Do they have the firepower? And hey, it's not just us asking this question. This quote shows you the Federal Reserve itself is laser focused on this exact problem. They know that in a crisis, these dealers are absolutely essential. On the surface, things look pretty good. The dealers seem more than ready for the job. You add it all up, and they have an estimated $7.3 trillion in headroom. That's just a fancy way of saying they have the capacity on their balance sheets to buy a whole lot more assets, like U.S. debt. But, and this is a huge but, that capacity isn't a fixed number. See, when markets are calm and everything's running smoothly, yeah, they have plenty of room. But the moment a crisis hits and things get volatile, their own internal risk models kick in, and their ability to buy up assets shrinks at the exact moment the market needs them the most. This entire system, the auctions, the dealers, the demand from all over the world, it's all built on one thing, one incredibly powerful foundation, the unique role that the US dollar plays in the global economy. Economists have a name for it, the exorbitant privilege. And it's exactly what it sounds like. Because the dollar is the currency everyone in the world uses for trade and savings, America gets some pretty amazing perks. It gets to borrow in its own currency, and it gets to do it more cheaply than basically anyone else. It's a genuine financial superpower.
This quote from way back in 1971 just nails it, doesn't it? The dollar is our currency, but your problem. It perfectly captures that dynamic, the power that the US has, and the fact that the rest of the world just has to deal with whatever America decides to do.
And you can see just how dominant it still is. I mean, even today, the dollar makes up almost 60% of all the reserves held by central banks around the world. It dwarfs every other currency combined. So why does any of this matter to you? Well, here's the bottom line. This isn't just some high finance theory. The world's trust in the dollar and its hunger to buy U.S. debt directly helps keep borrowing costs low for everyday Americans. That interest rate that gets set in those treasury auctions, it has a direct ripple effect on the rate you pay for your mortgage, your car loan, even your student debt. But that trust, the very foundation of this entire system, is starting to show some real cracks. For the first time in generations, people are starting to question things. I mean, just look at this timeline. You can see a clear pattern emerging. We've had a series of unprecedented credit rating downgrades. S&P, then Fitch, and now Moody's. All of them are sending the same signal to investors around the globe. Hey, America's political and financial risks, they're on the rise. And countries aren't just sitting around and watching, they're taking action. Central banks are buying up gold to diversify away from the dollar. Nations like China are building entirely new payment networks so they don't have to use the US system. And you've got big geopolitical blocs like the BRICS nations actively trying to figure out how to trade with each other in their own currencies. Look, the dollar's dominance isn't going to vanish tomorrow. It's still the backbone of global finance. But for the first time in 80 years, its top spot is no longer a sure thing. The ground beneath the global financial system is shifting, and it leaves all of us with one final, absolutely critical question. For 80 years, the world has run on the dollar. What are the next 80 going to look like?